Hello. Good morning, everyone, and thank you so much for braving the weather to be here with us today. Now, today we'll explore how investors are adapting from redefining early stage bets to finding new ways to create value when traditional exits are taking longer to come by. We're really lucky to hear from two seasoned investors who've lived through multiple waves of disruption. Larry Lee, founder and managing partner at Amino Capital, and Brett Gibson, managing partner at Initialized Capital. Thank you for joining us. And could you tell us a little bit about your work and yourselves?
Yes, my name is Larry Lee, founding partner of Amino Capital based in Palo Alto, California. We have a 20 unicorn, and we have been on the Forbes Midas list 3 years in a row.
And Brett?
Yeah, I'm Brett Gibson, managing partner of Initialized Capital. We're a seed stage venture capital firm based in San Francisco and New York, and quite generalist. My background is as an entrepreneur, started multiple companies.
And we will ask you about that later. Now, let's start with the bigger picture. This question is for both of you. AI development today can require hundreds of millions of compute before it can find product market fit. So how has that changed early stage funding for you, Larry?
I think it's a huge change for large companies, especially for AI, for Google, for Meta. But for early stage companies, AI is becoming a utility. There are 5 major LLM in US, so they're competing with each other. The price of utility is getting lower, so it's very good for startup founders, and they don't need to hire very expensive engineers. They don't need to buy all kinds of machines. They just need to turn on the tap, and the AI is here. So single founders, smaller teams have a much better chance to make revenue.
Thank you. Brett?
Yeah, I would largely agree with Larry. I think that we're not really going to think of the AI startups and that much into the future. It's going to be like part of every startup, certainly every software startup. And so all the expenditure that's going into the frontier labs is like upstream of all the investments we invest in across software businesses, even non-software businesses. It's a tailwind to startups broadly.
Mm-hmm. Thanks, Brett. Thank you for those perspectives. Now let's zoom into each of your own playbooks and your secret sauce, right? So, Larry, as mentioned, exits are slowing down, timelines are stretching a little bit longer. How are you redefining success for your LPs? Do you use different metrics now?
Yeah, it's quite different. Usually in Silicon Valley, a company from zero to unicorn normally takes 7 years. From unicorn to IPO, 3 years. But nowadays, because the huge amount of money, lots of companies, they don't need to go IPO. They still raise a lot of money. So the horizon for us is becoming much longer. So in this case, we are very much focused on the company to stay alive, making revenue. And fortunately, there are new tools coming up. Like one of the company we invest about 10 years ago called EquityZen. It's a marketplace for founders and employees to trade their share before IPO. So that gave founders, employees, and early investors a way to exit. Also, of course, the acquisition is also a good way to go.
So share swap sort of exit option and then acquisition as well.
Correct.
Yeah. And revenue focused rather than profit focused for yourself. Okay. For Brett, you've sat on both sides of the table, both as an entrepreneur, as an investor. How has that changed your perspective when you look at founders? Do you think that gives you a different edge?
Yeah, I mean, I think as early stage investors, we're very heavily indexed on the founders themselves when we're selecting companies. I'm a strong believer that the best companies are built and run by founders through their entire life cycle. And so having been on the other side of the table, I think the most important thing is understanding what good looks like, what it means to be a good founder. I think both from the things that stand out are just like velocity, cycle time, a certain impatience. And then, you don't really build enormous businesses unless you're a little crazy about being ambitious, because it's a little irrational to want to build a very, very, very big business, and along the way give it the chance to build a good smaller opportunity.
Do you look out for certain character attributes, or you're very focused on the product itself?
Yeah, mostly we're evaluating character attributes. I think that most of the things you evaluate in early stage venture are a proxy for the founder, even if you're looking at the market or their ability to build. And I think that being able to build your product is pretty common across our portfolio, almost a requirement. And then I think that you're looking for proxies of their cycle time and agency. I think obsession stands out as one. If someone has thought about everything about their category, that is indicative that they care a lot. And then and the other one that's harder to measure is just ambition level and raw, intenseness about what they want to achieve.
Thanks, Brett. Larry, I wanted to tag on this question quickly because I think we had a conversation about how you also view founders. You have a very pragmatic approach using AI to help you do a base score, right? Can you talk about that?
Yeah, so we have been using a system for almost 8 years. And in recent years, we use AI. Basically, we measure the founding team with 10 attributes. Some of them are very interesting, like if the team has worked in a certain place. Do they know each other? Are they siblings? Are they couples? Are they kind of lovers? And all kind of information we want to get. But it's confidential to outside. So we measure those informations, and based on those information, we follow the company. So whenever there's a change in terms of company outcome, we adjust those parameters, like based on, for example, where you come from. So we are very much interested in multicultural teams, international teams. So for each region, we have a score. For example, for people from EU, European Union, right? So we gave, suppose, 80 as a score. So if you come from Lisbon, maybe we add 10%. If you come from Spain, maybe we minor 5%. No, just kidding. So same thing with the workplace, right? Where did you work? Which university you go, right? If you go to MIT, that's okay. But if you go to computer science, we give a plus 10. Other major, we may minus 10. So based on the company's trajectory, so we make an adjustment. So this is helping us to filter out the companies we want to spend time.
Fantastic.
Very helpful.
AI-powered due diligence, right? Brett, back to you. In a market where, as mentioned, tech giants dominate distribution, data, talent, what sort of founders or startups or products still make you go and say, oh, this could actually stand on its own? I think you talked about the founder attributes a little bit, but maybe on the product itself?
Yeah, I think that there's... I guess I would have guessed a few years ago, thinking about the trends in AI, that the innovator's dilemma might not hold true this time, because it's very obvious that everyone needs to adopt AI. But practically, that has not turned out to be the case. And I think that what continues to be true, and why we have a cycling of incumbents, especially in the large software players every few years or generation, is that at a certain size and scale of an organization, you stop moving at the velocity that an early stage startup can. And so, it's kind of back to what I was talking about earlier. You see people that are like a little bit insanely impatient about what they want to accomplish and how they want to move their organization forward, and they're able to organize in a smaller and smaller team, especially now with the leverage of AI. And so I think you'll see these types of founders build the next generation of large companies. And I don't know, it's a little bit of my bias and DNA as a founder to not want to ever bet on big cos as winning out, but it seems like the same story is playing out like it has over all the past disruption cycles.
Thanks, Brett. Now, looking ahead, Larry, do you think independent startups can still build defensible moats and scale? Or are we heading towards a world where proving concept and getting acquired is the new success story?
I think in terms of a requirement, it's different. But in terms of building startups, the fundamental hasn't changed. I think right now, everybody is concerned about a large language model. It's very difficult for a company to do something obvious. So that's why we like companies that very focused on small things, so-called. We don't like startups that have a so-called big dream, doing something everybody need. Basically, those kind of features will be covered by the next release of a large language model. You don't want to do things so obviously good because a large company will do it. So we would rather to see the startups focus on very useful feature, just work on it. We call it the go narrow, go deep, go with the workflow. You got to find some niche, then get in. Build your startup, build your user community, accumulate your data. The data, it is very important because in this age, software is worthless. Vibe coding, the company we invest, called Replit, can allow a 4-year-old person, a 4-year-old child, to make a game and publish online. So software doesn't worth much money. The value is in AI, is in intelligence. But where the intelligence come from? Actually, it comes from data, the data you have. So as long as you have data, fresh data, live data, then you just open the tab of AI. Then you become an AI superstar. That's how a young company, a startup company, can take a space and make it big. Just imagine the large language model, those big players, people put in a lot of money. They have so much data already, but whatever they do again, that's the data they still have, right? So, they can train whatever they can do, but it's like no new information. So what they really need is a data, a private data, domain-specific data. As long as a company, you build your strong data as a moat, you could either go IPO or you can be acquired. Those big players, they are hunger for data. As long as you have data as a moat, even you don't go IPO, they can spend billions to buy you, to acquire the company. So the opportunity is still there. We are very excited. Yeah.
That's a great tip. Yeah. Brett, for you, this is a question that's really interesting to me as a journalist. Beyond AI, are there any opportunities that you see that are underexplored? If you remain focused on AI, how do you differentiate your edge when everybody else is also chasing the AI theme?
Yeah, I think that as technologists, like everything we're thinking about at the moment is somehow informed by AI, but I actually don't believe the right way to express that view as an investor is to only invest in AI companies. I think picking up on Larry's point, it's becoming free to create software. And I think that's going to create, that's going to fundamentally change what's investable from a venture perspective in the AI landscape. And I think it's a naturally conglomerating force because once you have distribution, you're going to be able to look for more and more business lines. You're going to be able to move sideways. And if you're one of these new AI native software incumbents that I kind of proposed in my last answer, like you're just going to want to eat up all of an enterprise's spend that you can. And so the power law in software businesses is going to change. And so I think that all of venture is going to be looking out past software businesses like on a fairly soon timeline because that is going to be like this incredibly red ocean market for almost everything that is like rhymes with SaaS. And so that's what we're doing at the firm. We've moved out into hard tech and defense tech sectors. I think we've looked at a lot of stuff like space or robotics or materials. And I think that what's even more interesting about all those categories is that software is a key part of their cost component and their time to market component. And so now they are much more investable from a seed stage venture perspective than they perhaps 10 or 20 years ago were, because they would just cost too much money or take too long to put in a fund like ours.
Mm-hmm. Thank you. Now, just a quick follow-up. Larry, are you looking beyond AI as well, or?
Yes, we do. Actually, we are always focused on data. Like before, we say software is eating the world. Today, data is the mode, is the king. So we always look beyond what's going on now, because most of the unicorns we invest what nobody wants to invest. So we don't want to invest in obviously good ideas. So we want to help the people that really need certain help in a very specific area. We don't care about really the AI. AI is just the natural evolution of a milestone. Yeah.
You mentioned yesterday to me about a very specific use case that one of your portfolio companies at a clinic, right?
Mm-hmm.
Could you, so that corresponds to your philosophy of going narrow and very going deep. Could you tell us a bit about more?
Yeah. Like, for example, one of the company we invested, they are basically helping the small business, like a clinic, to answer the customer call, patient call. So for a clinic, they have to hire quite a few people to answer the call. That's one part of it. Another part is the clinic. In US, the Medicare system is messed up. You have the treatment, but the clinic spend a lot of time to call insurance. The insurance tried not to pay. So it cost them a lot of time. But now this company provides the AI system to call the insurance. So the insurance let me to wait, that's okay. We have an AI system calling the insurance. It doesn't matter how long we wait because we can call 5 or 6 insurance at the same time. So that really saves people's time and enable the normal people to fight with a big company, enable the people who really need help to get help with very low cost.
Brett, off the top of your head, any portfolio companies that you want to highlight and that demonstrates your investing philosophy? Yeah.
One that's in recent memory is a company called Abito. They create satellites to fly in very low Earth orbit, and they just put their first satellite up. So it's been kind of on my mind lately because I've been pretty excited about just watching the journey from investing a few years ago in what was a relatively new domain for us in space to a bunch of first-time founders who were able to build a like refrigerator-sized satellite from nothing and then send it up there, and it's working as expected in their first commercial mission in very low Earth orbit. So I'm very excited about what they're up to.
That's fantastic. Thank you. Thank you to both Larry and Brett. What we've learned today is that venture isn't disappearing. It's just simply evolving, right? So Larry reminds us that we need to stay focused, stay narrow, accumulate all the data that you need. That could create your own defensible moat and create very specific products for specific use cases, right? Brett highlighted founder attributes, certain founder attributes that VC investors are looking for, and perhaps going beyond AI and going into hard tech, right? As you mentioned, hard tech and defense and not just SaaS. So if you're about to launch your own venture, or if you are wondering how to stand out among VC investors, or if you're an investor inventing your own playbook, I hope this session has been helpful to you. Thank you so much again for joining us, and enjoy the rest of Web Summit Lisbon. Thank you.
Thank you. Thanks.